Welcome to another explainer. Today, we're breaking down a really fascinating, highly systematic intraday bias trading model. We're pulling this directly from a source strategy that generated a massive 216% return over the course of just 230 trades. To put that into perspective, we're talking about an average return of over 10% a month when it's traded perfectly. But what makes this system so compelling isn't just the sheer profit, it's how brutally simple and rule-based it is. Okay, let's dive into this. Here's our structured roadmap for the day. We'll start by uncovering the 33% win rate secret. Then we'll walk through the 5 strict rules of the Directional Bias playbook. And finally, we'll reveal the missing ingredient that ties the whole shebang together. Now, keep in mind this strategy relies on a strict, chronological checklist. If you fail even one single rule, you toss the trade. No exceptions.
All right, Section 1, the 33% win rate secret.
To really grasp why this playbook is so effective, we have to tackle a major misconception about what mathematical success in trading actually looks like. 33%. That is the jarring reality of this model's win rate. Now, a lot of people see a 33% win rate and immediately think, well, that strategy is a total dud. It completely challenges the everyday assumption that you need to win most of the time to be profitable. But in the world of high-level trading, win rate alone doesn't actually mean much.
And this brilliantly illustrates exactly what we're talking about. You are actively losing 2/3 of the time. You are literally wrong twice as often as you are right. Yet, believe it or not, this exact distribution is the foundation of a highly lucrative strategy. So how on earth is that mathematically possible?
Well, the puzzle is solved by your average risk-to-reward ratio. In this specific playbook, the historical data shows an average win-to-loss ratio of 1 to 6.23. That means for every single trade you lose, your eventual winning trade brings in over 6 times your initial risk.
Let's walk through a quick micro-story to prove this mathematically. Imagine you take 10 trades, and you're risking exactly $1,000 on each one. Because of your 33% win rate, you lose 7 of those trades. Boom, you're down $7,000. Your confidence is probably pretty crushed, right? But wait, you nail the other 3 trades. Because of that 6.23 multiplier, those 3 wins generate $18,690. You subtract your $7,000 in losses, and you walk away with a massive net profit of over $11,690. Dropping 7 out of 10 trades suddenly doesn't sound so bad.
So how do we actually capture those massive 1 to 6 risk-to-reward trades? Well, we use this exact 5-rule playbook right here. Let's outline this visual map to set up the logical flow for how we actually achieve that math in the live markets.
Section 2. Rule 1. Directional Bias. Step 1 is establishing your directional bias. You have to identify if the overall market is in a bullish expansion, a bearish expansion, or just plain consolidation. To figure that out, you need to spot a reversal. Now, the source material uses some heavy smart money concepts jargon here, specifically change of character or CO choke. Let's translate that. Think of character as a behavioral shift. It's simply the moment when market control flips from the buyers, the bulls, breaking structural highs, over to the sellers breaking structural lows. The bulls lose control, the bears step up, and your bias officially shifts.
But, as you probably know, the market is rarely a clean, straight line. It's messy. So, to avoid getting tricked, the source relies on the box method. Imagine drawing a box between the highest external swing high and the lowest external swing low. Everything bouncing around inside that box? It's just internal noise. Ignore it. Until the price definitively breaks out of the top or bottom of that box, your overarching bias doesn't change. It keeps you grounded.
Section 3. Timing and Liquidation. Now, what's really interesting about this slide is how aggressively strict the strategy's execution windows actually are. Rules 2 and 3 dictate exactly when and where you are allowed to pull the trigger. Because even with the right direction, you can't just trade whenever you feel like it. The strategy maps out 2 exact, uncompromising time windows. The London session from 2 a.m. to 5 a.m. Eastern, and the New York session from 7 a.m. to 10 a.m. Eastern. That is literally it. If you see a picture-perfect setup at 1:58 a.m., it is strictly ignored. If it happens at 5:05 a.m., you walk away. Sticking to these exact windows is non-negotiable.
And even if you're in the perfect time window, Rule 3 demands a liquidation. What does that mean? It means a key area of old price action must be deliberately taken out before you enter. Say you're trading the London session. You must wait for the market to push up and aggressively take out the high of the previous Asia or Frankfurt session first. That liquidation traps eager breakout traders and provides the actual fuel needed for your reversal to work.
Section 4. Confirming the reversal.
This brings us to Rule 4. You've got the right direction, the right time, and the liquidation sweep. But blindly jumping into a trade just because those boxes are checked, that's a great way to catch a falling knife. We have to wait for structural alignment. We look at the 15-minute chart for our big picture bias, but we need the 1-minute chart for our confirmation. If your 15-minute chart says sell, but your 1-minute is still making higher highs, you sit on your hands. You have to wait for that 1-minute chart to shift and match the 15-minute chart. When they finally align, that's a green light.
Section 5, the final entry model. Let's move to and see how this builds into the actual trade execution on the 5-minute chart. So, you've confirmed the reversal. Now where exactly do you place your order? We scale to the 5-minute chart to find our exact launch pad. The primary target for entry is something called a fair value gap, or FVG. Let's demystify this real quick. A fair value gap is basically a zone of mutual agreement, an area on the chart where buyers and sellers agreed on price, creating a pocket of heavy volume. When price violently breaks out of that area, it almost always returns to that exact pocket to pick up remaining orders before rocketing off. That gap? That's our target.
To finally pull the trigger, a trader looks at the 5-minute chart for specific signals, an order block, a fair value gap, or an inverted fair value gap. But the real magic? The real magic happens when you stack these confirmations. Finding a zone where an order block and a fair value gap overlap drastically increases your probability. You place your entry right there, tuck your stop loss safely behind the structural high or low, and target that massive 1-to-6 payout.
Finally, Section 6, the missing ingredient.
We've walked through the entire 5-rule playbook. It's totally logical, it's mathematical, and the historical data is undeniably incredible. But here is the counterintuitive, sobering reality. Having this exact, highly profitable playbook still isn't enough to guarantee you'll make money. According to the source, the actual trading strategy only accounts for about 33% of your success. A staggering 67% comes down to other critical factors, namely your trading psychology and risk management.
So the crucial point is perfectly captured in this quote. Trading strategy is only 33% of the equation. Think back to our math from the very beginning. You are going to lose 67% of your trades with this model. Can you actually hold your nerve through those drawdowns without revenge trading? Can you take 6 losses in a row and still strictly follow the 5-rule checklist on the 7th try? That mental fortitude is strictly required to survive long enough to catch the 3 winning trades that make you profitable.
Which brings us to the ultimate question for you to ponder today. We've just handed you a completely mapped out, data-backed playbook. But if the perfect strategy is only 33% of the equation, are you ready to master the other 67%? The mechanics of the market are absolutely fascinating, but mastering your own mind might just be the greatest trade you ever take. Thanks for joining me on this explainer, and I'll catch you next time.